Hey everyone, today on the final bar, caught up with my friend Jay Woods earlier today, usually from the floor of the New York Stock Exchange today, as with many of us remotely, but talking about his market outlook, also just the experience of going from a floor experience to a remote experience. We're going to try to debrief on the market activity, choppiness today, but overall finishing in a position of weakness, relatively speaking. So we're going to unpack all of those themes in our Wrap the Week segment. Ladies and gentlemen, this is the final bar. Hi there, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks so much for joining me every weekday after the close to take a look at today's trading activity from a technical perspective, try to connect what we're seeing today with the longer-term trends, make sure we're on the right side of things and avoid being on the wrong side of things. Today, once again, I feel like every day seems to encapsulate this experience. You get basically broad distribution out of the open. After about the first hour, it was certainly, sellers taking control, supply increasing, demand drying up, whatever it is. You certainly get more weakness than strength. But then in the last hour or so of trading, just faint glimmers of hope, keeping you interested, keeping you expecting that there could be a potential bounce here. So we're going to try to make sense of all of that and think about the longer term trends where we're left after this Friday's close. Coming up on StockCharts TV, we have some really good content. We've been blessed to have some fantastic guests this week. If you missed any of them, go to our YouTube channel. You can check them all out. Next week, we have Chris Shavacco on Behind the Charts. That's our interview show every Monday, midday. Chris is based in Atlanta, runs a money management firm, and had some really good thoughts on visualizing market history you're not going to want to miss. After that, on this show, we have Harry Boxer on Tuesday. On Wednesday, Jesse Felder. And on Thursday, John Kosar. And on Tuesday, I'm going to do a special event called 7 Bear Market Mistakes, How to Avoid Them. This is for an event that I did not too long ago. And I found that it was pretty well received, just this idea of, what we've learned from historical bear cycles. So I wanted to present that to all of you. That'll be airing this Tuesday. So on this show, we want to recap the week. And what we're going to do is do our Wrap the Week segment every Friday. We love to take a step back. Now that Friday's close is locked in, we've got the weekly bar in place. What does this mean? And I would say by any measure, this week has been crazy. Crazy is the adjective that I'll use to describe it. And it's funny, I was joking with Jay Woods. We'll hear his discussion earlier. We caught up with him via phone earlier today. And, he made the comment. We saw him on the floor of the exchange in December. It was right before the Christmas holiday, the holiday season. And we made the comment about how we were looking for volatility. Volatility was so low. It was like things were just kind of boring. And boy, I feel like our cup runneth over with the volatility we were expecting or hoping for back there in December. This is what the week looks like. Looking at the last 5 trading days, you can see Monday was actually a rare up move. Mondays have actually been kind of weak going back over the last 6 weeks or so. It's actually rare to see a nice uptick on a Monday. Tuesday, we sort of gave it back. Wednesday is where we really started to feel the pain. And again, then Thursday back up, Friday back down, and sort of this, swinging pattern back and forth. So directionally, down a bit on the week. But overall, I feel like this week was more marked by the volatility and the indecision. So you have up days, you have down days. There's no real clear differentiation between the two. When you look at the daily chart of the S&P, that's sort of what this feels like. After that big sell off into last Monday, right, a week ago or a week or two ago, you had this big jump higher on the S&P. You had the rally back to just below 2650, and now we're sort of in the middle of that range. And the question now, I think, on everyone's mind is just where we're at relative to these extremes. We've now sort of hit an equilibrium of sorts around the 2500 level, and now the question is, what's next? All right, what's that next move? We're going to come back to that, try to make sense of it. But just very quickly, what you have to look at today is the S&P finishing down 1.5%. Small caps and mid caps down even more. I think that's very telling. Small caps down 3.5%, so much much deeper. In terms of sectors, it was really more defensive led when you had staples and then real estate at the top. Consumer staples, the only sector out of the 11 on the positive today, with utilities, materials, financials on the way down. Going back to the daily chart here, one of the questions that I would think about is where we're going next. We have a poll that we asked not too long ago about where people were potentially expecting the market to go next. Was it going to go above 2,800, below 2,300, or end up in the middle over the next couple months, right, ending at the end of the second quarter? The average answer was right in the middle. We had a very small percentage saying above 2,800, but we'll call you our raging optimist. I think it was about 10% of respondents. So that's impressive optimism there based on all the headlines we're seeing. But listen, you could absolutely be right. But then most people said we would either be within this range or lower. So I think it's telling that about 90% of our respondents say we would be below 2,800 3 months from now, which I think is completely reasonable. And again, a lot can happen in 3 months, but I don't think that's necessarily far off. In the short term, and I think this is, in our mailbag segment, we're going to answer some questions about this, but I would say in terms of short-term levels as we finish the week, we always start with the final bar, start with the current price bar, and then look back to the left. Where are we at relative to key support and resistance levels? The last couple of days has given us a key support level right around 2,450 on the S&P. So as long as we hold that, I think we're relatively stable. We're in good shape. We break below 2,450. I immediately am looking down to 2,200, to be honest with you. I think that's the next key level that you could expect support. However, if we rally and break above 2,650, that's the key resistance from earlier on in the week, also from last week. And that also lines up with the Fibonacci resistance level. So we're kind of very fortunate right now to have some clear levels in place. We break above 2,650, we break below 2,450. I would argue whichever way we go, that's the short-term direction of momentum that you certainly want to try and follow. To wrap the week, we usually like to look at the Mindful Investor Live chart list. If you've not looked at this before, just go to the articles tab, go to my section, Mindful Investor, and you can download this directly to your StockCharts log and use them at your leisure. But we'll start at the top here. So this long-term trend following model just turned negative last week. This is our long-term model based on the 21 and 34 week exponential moving averages. So it remained positive, coming down, very quickly, but still remaining positive until last week when it finally triggered negative. Our shorter-term tactical model turned negative mid-February and remains in a position of severe weakness, really lining up with historical bear market phases. We're talking back to the 2008 period, to be honest with you. Last time it's looked this severe to the downside. So overall, suggesting it's more weaker than stronger. You want to be thinking more potential downside here. The cumulative advanced decline lines are interesting. We haven't locked in today's close yet. And so I think the question for me, along with the broader market, is higher highs and higher lows, or lower lows and lower highs. We're coming off of a lower low. That's this bottom here from the third week in March across the board on all of these breadth measures. We've now bounced up a little bit, establishing a lower high. And now the question is, do we find a higher low? Do we remain above a week ago reading, or do we break to new lows? We continue this pattern. And I think we'll see how today locks in as we digest all the breadth readings from today, and also see how we go into next week. As a final reminder here, I just want to point out with breadth, I'm always looking at the stocks above their 50 and 200-day moving averages. I think it's really telling that the stocks above their 200-day, stocks above their 50-day have really eclipsed the short-term bull market bottoms that we saw back here in the last 10 years. We're looking a lot more closely related to that late 2008 period, which means we're at the beginning of a process. That reading where we're at now, if you use that parallel, the bottom didn't come for another 5 to 6 months after that first initial bombed out reading. So the breadth picture, in my opinion, remains relatively muted. To give enough time for a conversation with Jay Woods, which I do want to make sure we get to, we're going to cut that short for the wrap of the week. If you have time to go through that Mindful Investor Live chart list, you're going to see a lot of ratios that help paint the picture. But again, overall, I think we finished this week, in my opinion, confirming more a bearish bias than a bullish bias. I do want to get to our next segment, which is the final bar mailbag. So a great part of the show, one of my favorite, is being able to interact with all of you. Thanks so much for everyone sending questions in and feedback. You can get questions to us anytime via email, thefinalbar@stockcharts.com. We'd love to answer your questions in a future mailbag segment. We'll go quickly through a couple of these. Question number one, And I'm going to summarize on yesterday's segment. This is from earlier in the week. You stated that we were making a higher low. Can you explain that more? At the lowest point, we came back up and kind of consolidated. Then on Wednesday, we dropped below those lows. I'm still trying to learn technical analysis. I want to better understand. It's a really good question. We're going to go to, let's see where we want to go here. Let's go to this chart here. I think this is just the daily chart of the S&P, but I think it'll provide a good sort of preset list for us to look at. Here we go. So when I'm looking at the market, when I'm thinking of the charts, for me, it goes back to Dow Theory. And Charles Dow, over 100 years ago, had this idea that markets move in trends. And to summarize, he described that an uptrend was a series of higher highs and higher lows, and a downtrend is a series of lower lows and lower highs. And the way you do that, in my opinion, is don't look at every move, don't look at every bar. You want to point out, if you look visually, you can see sort of the key bars that stand out. So here, end of February is sort of a low that was sort of sticks out. Here, first week in March, you have a little peak. Then we have a low maybe here, and third week in March, we then have the peak from last week. And as you do this in any time frame, it's a fractal sort of thing. So any time frame, you can identify those peaks and valleys. And Charles Dow's idea was to determine the trend. You look at those peaks and valleys and you see whether they are trending higher or lower. So what happened when we had this new low here the third week on March 23rd sort of confirms that we're in a bearish territory because we keep making new lows. And then as we go and make the new swing high, the question is, where are we at relative to the previous highs? And this is where it gets a little bit of a gray area, right? Because you could argue, if you have a shorter term time frame, that high from sort of the middle of 2 weeks ago was a lower high. And so here we have a higher high and we're now in an uptrend. But from my read, I'm looking at the big long-term trends and I'm seeing this, 1, 2, 3, and I feel like we're in that fourth kind of, sort of a little bit of a pullback, and I still see it being a lower high. And now the question is, do we make a lower low? And do we either break below 2,200, confirm a new low going forward, or do we go above here? And that would establish a higher high and a higher low. And I would say the primary trend then reverses to positive. So that's what I mentioned in the introduction when I talked about us being at a really key level. I think a break above 2650 sort of gives you the Dow theory, according to that we're in an uptrend, that we're able to establish a higher low and now a higher high. But if we break below 2450, that does not confirm that. It suggests that I think the bearish trend is still in place. So in my opinion, the bearish trend is in place until you invalidate that by getting a higher high and a higher low. And thanks for the question. There's a bit of subjectivity there for sure. Question number 2, and boy, these go quickly. Let's see. Wasn't today, April 2nd, a follow-through day? It's talking about this price bar right here. This is Thursday of this week. Yeah, I throw around terms like follow-through day and confirmation and validation. And sorry if I don't spend enough time really clarifying what I'm seeing there. But, in general, when I'm seeing a follow-through, it's basically when you see a signal, when something happens. So when you get this breakout right here, this long up day, my always question is, after that, do you get a follow-through day? The next day, do you get a follow-through, meaning a continuation in the same direction? So, when we had a pullback earlier this week, this was on Wednesday, and then we had the rally yesterday, that's when I would think, okay, are we going to get a follow-through? Meaning, do we get further upside today? Does Friday's close go back above the previous day's range and follow through to the upside? Because we had sort of a bullish engulfing pattern, right, where we sort of had a nice rally. Do we follow through today? And I would argue we did not. So for me, when I'm using those words, it's all about, you have the initial move, and then do we follow through? Do we get confirmation from a subsequent day? And that's something I've learned from a lot of mentors. Tom DeMark sort of comes to mind, working with him a lot years ago, talking about getting a signal and then getting confirmation, some validation from a close, the next day's open, something like that. And I think there are a lot of different ways to do it. I tend to keep it a little more subjective, a little more qualitative. I'm just looking for a sense that traders and investors are pushing the market continuing in that direction. That's all the time we have for the mailbag today. We have a lot of other questions that we will get to certainly next week, but I want to get on to our conversation we had with Jay Woods. Jay's a friend of StockCharts. I've known him for a number of years and first visited him on the floor of the exchange years ago, and it's been such a great conversation ongoing that we've had for a number of years. Jay's an executive floor governor on the NYSE, and also is a designated market maker for IMC, one of the market making firms on the floor. He's been on the floor for a number of years, has great experience. We caught up with him earlier today just to learn about this transition as the floor has been closed due to the coronavirus. How has that transition been? And also, just what is he seeing in terms of the mood, in terms of the patterns? So here's some of my conversation from today with Jay Woods. So folks, today we're actually joined by a friend to StockCharts, Jay Woods. Jay's an executive floor governor on the New York Stock Exchange. He's a designated market maker for IMC. We had such a great time visiting him on the floor of the exchange before year end. And great to have you on the show today, Jay.
Hey, Dave, it's great to be here. Interesting times, but you know what? It's good that we can, talk during some of the good times and some of the crazier times.
Right. I feel like the world has changed a lot since you and I last sat down together. Obviously.
Yeah, well, for the people listening, we the last time we sat down together was over the Christmas holidays, and we were going through a period where we were complaining about lack of volatility. There was a 71
I distinctly remember talking about that.
Yeah. I had to look it up before it came on. There was 71 straight days where there wasn't a 1% move up or down in the S&P 500. And now we're praying for that 1% move to calm things down. And, it looks like we're getting it today. So, yes, the world has changed since we last spoke.
So speaking of that, so right when you and I met last, and again, it was such a great time to visit you on the floor. It was really during a huge bull phase, excuse me, this huge run up in stocks that have been going forever. And I'd love for you to just share how do things transition mood wise, at the New York Stock Exchange from the bull, everything's great, we're making new highs up until, early February. It's all of a sudden now where things get dramatically worse so quickly. I mean, there's that stereotypical picture I think a lot of people have in their set of the broker with the, head in their hands at the end of a tough day. What is life actually like in these different phases? Is it palpably different for you guys?
Yeah, it's different in so many senses. The number one sense is they've closed the trading floor temporarily, and the key word there is temporarily. It wasn't safe for us to be at work. In fact, and this was common knowledge, it was in the papers, I believe 6 members of the floor actually did catch the virus. They tested for it positively. So when you say how's it changed, it's changed on 2 levels. The first and foremost is that, the personal, the physical level, the family level. How are you dealing through that crisis? And then the work, the functionality level. So let's just focus. Everyone's healthy here, so we're good on that regard. But we are working from home. And that is something that has never happened in the 228-year history of the New York Stock Exchange, where the floor was open, but there was no human element there. We were prepared. There are always contingency plans in place. This goes back pre 9/11. Before 9/11, there used to be a warehouse in Brooklyn that people don't know about that had a model replica of the New York Stock Exchange. And once a year, we would go and we would train in this top secret facility just in case anything ever happened that compromised the building on the corner of Wall and Broad. Since then, the technology's taken over, and we have contingency plans in place. Like if there was a Hurricane Sandy, we closed for 2 days. That was market-wide, so there was no, problem with that. But with this virus, safety was a major concern. And the last thing we wanted to do was shut down the markets. So the contingency plans were in place where we could trade offline. So I'm taking a quick break to talk to you right now as my team and all the teams of the floor market makers are assembled on their computers, and we work into our systems, being able to access them like we were actually standing on the floor and providing liquidity and, trading the stocks we make markets in. It's missing so many key aspects like feel and, getting a sense of what's moving the market and having that personal connection, talking to the people and that floor broker community around you. But it is working smoothly. But in all honesty, no one likes it. We're ready to get back to work. We're ready to get back to the floor. We need a little of that human touch. And as soon as it's safe, we'll go. There hasn't been that date set in the sand. Everyone wants to hear, okay, what is the go back date? That's the one question I get more than anything. It will be as soon as it's safe for everyone to come back. And knowing the floor community, there is a great sense of pride. As soon as we get the green light, we're going to go. just to kind of put it in perspective, is we got the first case of the virus Wednesday around 4 o'clock, right as we were closing stocks. They cleaned that day, but we were open Thursday, Friday. And our full team showed up Thursday and showed up Friday, knowing that, one, the NYSE was still monitoring us, doing the best they could to make sure our safety was paramount. And two, to make sure we were there. There was a sense of pride getting those markets open and being there on the floor. So that first day we get back and with that first bell ringing, it's going to be special. The only feel that's similar was when we shut down for a week after 9/11, getting back. Totally different times, but you talk about a feel and how emotionally you deal with it. There are a lot of similarities too.
It's interesting. I remember, and not to share, let too much out of the bag for the special we have coming up very soon, featuring our visit with you on the floor. But I do remember walking around with you. It was almost like you visiting a bunch of old friends. I mean, the relationships you had with the people on the floor, it was very noticeable how deep and how long-term and how personal that was. And I'm curious how you're transitioning to doing what you're doing now. How are you trying to maintain those, the personal interaction? Is technology providing some of that, or how are you trying to replicate or recreate that?
Oh yeah, it's technology. Whether it's FaceTime, Zoom call, we're constantly on a Zoom call all day with the entire team. The leaders of the NYSE on another level have been very back and forth with us and open to dialogue and keeping us informed as to what they're seeing. So technology has brought us all together. It's brought my family together. I have a college student and 2 high school students here, and it's amazing how we can manage so many different lifestyles under one house, and then going to the floor dynamic, keeping those relationships and talking to those people that you saw. You're not talking to everybody every day, but you're talking to the people that you did business with, that you wanted to hear their opinion on things, and this is what I value. And this is where something like a Twitter and a StockCharts come into play. I've spent more time going through charts and talking to people in the industry. JC Peretz, our good friend, had a great event this past weekend where you and I both got to present, as well as 28 other people in the industry. And one, we raised awareness for what was going on and funds to help out. And two, we got to put our perspective on things, because just because we're all CMTs and technicians doesn't mean we see things the same way. And, we just took a major shot, across the bow, a Great Depression-like crash. I mean, it was, 30% in 22 days. None of us have seen that. You have to go back and start reading history books and studying, what do I compare this to? And I remember doing one of my NYSE social media hits. If you follow the NYSE on social, you can see me from time to time talking with my friend Judy Shaw. And I made a comment, the only thing we can compare this to is the Great Depression. And then I got home and I thought about that. And I was like, maybe I was a little crazy by making that comment. And then after studying and talking to people like yourself, talking to my friend Brian Shannon, they go, no, you were kind of spot on with that. And to think that we're living through this now, when we just walked the floor 3-4 months ago and everything was great, is crazy.
Yeah, no, it's the truth. So we're almost out of time, Jay, but you hinted at sort of the environment we're in right now here, getting to early April. What are you seeing for the next couple of days, next couple of weeks? We've had this, huge rally out of the lows below 2,200 on the S&P, and now pulling back a little bit. Is this the beginning of the next leg down, or do we back and fill for a while? Is it a bottoming process?
Well, that is the million-dollar question. It's definitely a bottoming process. Now, a lot of people would like to see a retest of the bottom or come within a few percentage of the retest, and then we continue to go up. That would be healthy. What I'm seeing the last 2 weeks, we got that some people call it a dead cat. I don't know if I would go that far, but you got a nice retracement, a nice relief rally. I think relief rally is the best way to say it, because I think everyone was honestly relieved that this market finally rallied, and maybe I'll take a peek at my portfolio and that 401k and see how I'm doing. Today is kind of quiet. This week, we're about even, down slightly as I talk to you.
Yeah.
That's fine. Sideways and just digesting what's going on and taking a look at it as we see what economic numbers are going to kind of try to lead this market. But from a technical point of view, this was a constructive week. I don't think it, I mean, I would have loved to have seen a V bottom and a V-shaped recovery, and we may still see some great strength come from this. I'd like to see more work down here around the lows to make sure that bottom is in. I don't want to make a new low. I'd like to come down or stay around here and work our way up. But it's the $1 million question. I'm more in the conservative camp where I think we're going to be here for a little while. But as the news comes out and the virus dies down, that's what's going to move this market. The Fed has thrown everything they can at it. So I think the bottoming pieces are in place. It's just a question of when the individual investor, when the institutions really come into this market. Because on this relief rally, the volume was a little less. We're coming in now. There was really no strong bid. It was more of the sellers pulling away than buyers coming to the market. I want to see some strong up days, strong volume behind it, and with the right sectors leading. You know, technology has been great. Energy has been hot again after getting destroyed. But I'd like to see the industrials come back. I'd like to see the utilities and the REITs take a back seat, still go up, but not as strong as the rest of the market. So once we see more constructive bottoming here, then I'll get a little more bullish.
It's such a great take, Jay. Listen, I know there's a lot of tough headlines coming out of New York these days. So wish you the best, your family and your friends, and hang in there. We'll look forward to talking again soon. All right.
And I look forward to being back with you and back on the floor as soon as possible.
Sounds good, Jay. All the best. Thanks again.
Thanks for having me.
So that was Jay Woods from the floor of the New York Stock Exchange, actually remote from the stock exchange, a designated market maker with IMC. Just such a pleasure to talk to someone like that who has had experience dealing with the floor, with that, you know, open outcry system, with the, you know, with the emotional experience of that volatility, but also deeply aware and familiar with technical analysis. He knows it as well as anyone. And so I've always enjoyed getting his take on what he's seeing and hearing and how that relates to the chart. So thanks again to Jay Woods for a really good conversation. We need to wrap the show, folks, though, and go right to the 3 and 3. So at the end of every show, 3 charts, 3 minutes. Here we're going to go. Chart number 1 is looking at the yield on equities versus the yield on bonds. And I talk about this because we're in this situation where equities now continuing to be relatively weak, bonds continuing to be relatively strong. So if you look at the TLT, it continues to sort of chip away, closing higher every day overall, and week to week, it's looking pretty attractive. So you have this sort of divergence with weaker stocks and stronger bonds. I don't know whether or not that's going to continue, but what I do know is that the relative value of owning, you know, of getting dividends, of getting income from equities versus stocks is clearly favoring equities. And the way I'm doing that is looking at the yield on the S&P using their dividends versus the 10-year treasury yield. So what do you get back for owning stocks versus owning bonds? And again, this is on average across the board. We can see the trend has been going up because stock prices have gone down and dividends in general have remained relatively stable. And then you see the yield on the 10-year obviously going down, making new lows. And that has made that ratio, that difference from stocks versus bonds to be at a new high. So it's telling you from an income perspective, clearly equities are the place to be. And that's just using the S&P. If you think of something else like utilities or REITs or something, there are places paying much better dividends for sure. Chart number 2 is looking at the AAII rankings. We didn't talk about it. We didn't have enough time today wrapping the week, but I did want to point out the fact that the number of bears has actually decreased, which I find absolutely fascinating. So in an environment when the market continues to show weakness, you're actually getting less bears. Now, whether they're going from bearish to neutral or bearish to bullish, I'm not sure, but I know that the bulls are remaining relatively stable. So still you have half of respondents more negative than positive. And I would just remind you, if you look back at previous bull market pullbacks, this is about right. But if you look back at bear market cycles, 08 and 09, this number can get a lot worse, 60% or more. And I'm curious to see if and when we would see that sort of move. And finally, I want to finish off with gold. Again, at a time when stocks are struggling, I'm always looking for charts that are sort of in a steady uptrend. Gold appears to be it. And especially on a relative basis, if you look, it's outperformed the S&P by about 38% in the last 6 weeks, which is not too bad. And ladies and gentlemen, that is our show, and that is a week on the Final Bar. I want to thank you so much for going along this journey with us for the Final Bar and StockCharts TV. Please keep your questions to us, coming to us, the Final Bar at StockCharts.com. We will get to many more of them next week. For StockCharts.com in Redmond, Washington, this is Dave Keller. Be safe. Have a great weekend. Bye now.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.